Hello and welcome to the Flying Frisbee podcast with me, Dominic Frisby. Today it's my pleasure to be talking to Joshua Saul, who is the founder and I believe the president of the Pure Gold Company. Have I given you your right title, Josh?
Well, I'd be very honoured to be a president of anything, but I would say I'm the founder and chief executive officer. Happy to be known as the president in any manner of speaking.
I think president is a North American company thing.
It certainly is.
So, um, Josh is kind of very much at the coalface, if you like, of the gold markets. His fingers on the pulse. He talks to all his investors all the time, and he sort of knows exactly what's going on, which is why I've got him on to talk about gold at the moment. And Josh, let's start. What are you seeing in the gold markets at the moment? The price obviously is a little bit depressed. I've seen worse. I've seen better. But what are you actually seeing? At the coalface.
Well, I guess there are three stories. You've got the gold price, which I'm going to put to one side. You've got what's happening from a market point of view, and then you've got what happens from a personal point of view. And we're one of the very few companies that actually get to speak to every one of our clients, and so we have a consultative approach with the people that we speak to, and what that gives us is a flavour for why they're doing what and when they're doing it. A lot of people make decisions. Some of them are emotional, some of them are influenced by logic, but what we get to find out is exactly what's prompting people to do what they're doing. And so what I'll do is I'll start with what we're seeing within the gold market generally. And I think what you'll see actually is that it's mirrored somewhat on the retail market. We've seen a huge amount of demand from unexpected sources over the last, I'd say over the last 6 to 7 months or so. Last year, we saw central banks purchase more gold than any other year since the 1950s. It was a 152% increase from 2021. The Royal Mint, who we are an authorised distributor of, reported a 26% uplift on gold investments with a 33.5% increase on gold bars. And so, regardless of what the price is doing, demand is most certainly increasing. And the correlation we're seeing actually is as the price is dipping, different types of investors are purchasing. And so on the private side, on the retail side, which is where we're involved, what we're seeing, I mean, we've seen a 400% increase over the last 60 days from financial professionals who are very concerned about the rising cost of debt, the rising cost of their mortgages, and they've been purchasing physical gold. Gold coins, gold bars, silver coins, silver bars. And again, for us, we go further than that to find out exactly how are they funding their investments. Is it coming from equities? Is it coming from property? Is it coming from savings? What are people worried about? And I would say that at the moment, people are very, very concerned with the rising cost of debt. People's mortgages are either right now unaffordable, or there's a systemic fear that mortgages will become unaffordable. And so we've seen a good amount of clients either selling property and using the proceeds to purchase physical gold, i.e., they're selling property, they're downsizing, or they're moving out of an area that costs as much as it does at the moment, and any fund surplus to requirements they're putting into physical gold. We've also seen a considerable amount of clients put other buy-to-let properties on the market with a view to selling, with their intention to put those funds into physical gold as well. And so, as the price of gold has come down, I would say that the insurance that protects people from the likes of inflation, a fall in the value of other asset classes, but provides more value. And I think a certain part of the market, the financial professionals, tend to see that far more than, I guess, the rest of the market that tend to buy when they see the gold price racing up, beyond the $2,300 mark, because it happens to hit every single headline. And so, to summarize, the smart money who have exactly the same concerns and fears as everyone else, they might be perhaps a little bit better informed. We're seeing a huge increase in gold demand, on account of worries such as mortgages, rising costs of debt, counterparty risk that they're seeing in the banks, banks being unstable, um, and of course, the expected fall in the value of general equity indices.
And would you say so? There's a lot of smart money moving into gold. There's a lot of money moving out of real estate into gold, I guess, spurred on by higher rates. And just to clarify one thing, are you saying a lot of retail? There's a lot of retail demand, or it's slightly smarter than financial professional retail demand, if you see what I mean?
So I mean, predominantly we deal with retail clients, and you've obviously got a range of clients from the sophisticated to the perhaps non-sophisticated. I'm sure they're sophisticated in lots of other areas of their life, but when it comes to finances, perhaps they know a little bit less. At the moment, we're seeing a huge increase in the sophisticated retail market, the investment bankers, the accountants, the lawyers, the types of people in mergers and acquisitions. These sorts of people need less guidance. They seem to know what they're doing. And in a way, it was a very, very similar correlation to what we saw with the Brexit referendum, or the onset of the pandemic, or the day that Russia decided to pledge war on Ukraine. When those murmurs started to surface, it was the smart money that started to move in, and purchase physical gold. And once that started to hit the headlines as a result of the gold price moving up, then we started to see the rest of the market following suit.
And when we spoke back in, I guess it was in the autumn, you were saying that for whatever reason, there was an extraordinary high demand from doctors. Are you seeing anything like that now, where there's like one profession that seems to be buying more gold than any other?
It's hard to say. We try and pick up on trends where we can. And sometimes it's really difficult to do that because our target audience has moved over the last 5 years. 5 years, if you would have asked me who are our target audience, it's changed. And the reason for that is that 5 years ago, there are a certain segment of the market that had access to physical gold. They understood, what gold would provide them with in terms of protection, removal of counterparty risk, tax advantages. Plus, a lot of these people remember from 2008 and some of the other crashes, the benefit that gold provides. And without actually, without seeing or witnessing disaster or uncertainty before your very eyes, sometimes that concept becomes a little bit abstract. And I think the difference now is that, everyone, millennials millennials to Gen Zs can see that there is uncertainty. And I think that the big question that we get asked at the moment, and take into account that we do work with high net worth individuals and lawyers and accountants and bankers. We also work with doctors, and bricklayers and engineers and people that work for London Transport. Some of these people, I have to say, education or not, are some of the smartest people I've spoken to. And the one common denominator that keeps on coming up, the one question is, what in the world do we do with our money? Right? And it's a good question, because a lot of the time, because the target continues to move, people don't know, and we don't claim to always have the answer. And I think, in a way, the only certainty in today's world is uncertainty. And in a way, it's the biggest threat. we've had so many. We've had an embarrassment of riches, from the Truss administration to Ukraine, from China's ongoing COVID lockdowns. These black swan events are starting to occur with increasing frequency, and they they can't be predicted with any amount of planning or modeling, but they can be anticipated. And we're not operating with perfect information, of course, but I think what society have come to realize is that the next unknown could be around the corner, and it pays dividends to hold a small amount of one's wealth in physical gold and hope that it doesn't go up in value, because it going up in value is an indication that the rest of your portfolio has dropped. It might seem quite perverse. We have clients that actually purchase gold and hope their gold doesn't go up, because, as I say, they want, the gold is an insurance policy for the rest of their portfolio. But I think, going back to that question, and it's a question that we hear doctors asking, nurses asking. We've spoken to economists and MPs that also say, it's the same question. What do we do? Inflation's high, interest rates are not keeping up with inflation, and so if I store my money in the bank, I'm guaranteeing a loss to inflation. Plus, I'm risking it with counterparty risk. If I stick it in a bond, then I lose that flexibility. Plus, I've still counterparty risk. Putting it into property, again, it's not very liquid. And at the moment, people's outgoings are increasing by 500-600%. And so it's a really valid question. And I get it. I get the confusion. I think the way in which we handle most of these conversations when speaking to clients, it's not about us just talking single-mindedly about physical gold or physical silver. One has to look at these things relatively speaking, because actually, I'm a big fan of property. I've got property myself. I've got buy-to-lets myself. I'm a big fan of equities. I'm a big fan of having a pension. I've even dabbled in a little bit of crypto before. Do I regret it? I'm not going to comment on this conversation. But I think the point is that every investment has its moment. It's a question of timing. And I think at the moment, I think the question is, if we look at the alternatives out there, property, equities, cryptocurrency, leaving it in the bank, putting it in bonds, taking government gilts, there's lots of alternatives out there. The problem is that, there seems to be more risk than there is reward. And I think, prudent investors can choose to reject this, this Sophie's choice between losing quickly or slowly. I think the most prevalent trend that we've started to see, Dominic, is that as inflation creeps up, people feel the pressure to do something. And it might be anything, just that they've ticked a box to say, okay, I put my money to work. But actually, as we can see, to satisfy ticking a box so that you've done something to battle inflation, you might end up far worse than you did in the first place. And so, what we often hear from some of our wealthier clients, who tend to tell us more about the world than we're able to tell them, is that during times like this, it's the rich that get richer, and it's the poor that can get poorer. And lower net worth investors tend to buy and hold an investment even at high prices, because they're desperate for gains, even if it's falling in value. And they believe it's crucial to do something, even the wrong thing. Whereas the smart money, the money that tends to be slightly more informed, and we've got lots of clients that tend to work for hedge funds that tend to have far more access to research than the rest of us, they're slightly more patient. They know that bad decisions are expensive. We see that the smart money, they wait outside of the bubble, and they buy in again when valuations are compelling. And so, successful investors, they take smart risks. But when there are none to be found, they do nothing. And I would say that the one thing that the one conversation that keeps coming out with clients is in a market whereby lots of opportunities might start to present themselves in property, in equities, even in crypto. It might take a year or 2 years or 3 years, but if you can find a way to preserve wealth now so that you've got the same amount of purchasing power when those opportunities start to reveal themselves, then this is how the rich get richer. There are two ways that we articulate doing nothing, and you can passively do nothing, which essentially is, leaving your money in the bank, which is far more attractive today than it was a year and a half ago. But then, it's the margins change because, a year and a half ago, inflation was less, interest rates were less. Today, inflation's higher, interest rates are higher. You are guaranteeing a loss to inflation. People are genuinely concerned about banks. We know that I had a stat over here actually that I think you'd find interesting. Where is it? We've seen, I think, I can't find it, but it's close to 500 billion pounds have been withdrawn from bank accounts within the UK. And so, people are getting concerned about counterparty risk. The banks are exposed to, bonds and the rising costs of debt. And so, there's no real hiding place, regardless of how big you are. And so, if you're deciding to passively do nothing, putting your money in the bank, it does have its risk. You are limiting inflation compared to just putting it under the mattress. And you do have some flexibility, but you're guaranteeing a loss to inflation. And I think a lot of our clients like to see gold as, as a holding pattern. It preserves wealth. It allows you to patiently wait out the periods when risk outweigh rewards, and then it allows you to return to the market when valuations are compelling again. And I think the way to look at it is that, gold should be your dry powder that's ready to deploy when the overall risk reward environment is slightly more compelling. And that's why I said before, my customers are happy when their gold holdings drop in value because it means that the rest of their assets are going up, in price.
I've got you. All right. Well, as we close, Josh, one last question for you, and that is, do you have a long-term target for the gold price? Is there, I've heard some people talking about 2,700. Charlie Morris is talking about $7,000. Do you have a long-term target for gold?
Well, it's a tough one. Prices are set as always by supply and demand. And considering the level of inflation we're seeing and the near certainty of a global recession, I don't expect demand for gold to go away anytime soon. Gold will continue to play its wealth protection role. Supply, on the other hand, is more complicated. Mine production does not respond to price changes quickly. There's a 10 to 20 year lead time between finding a new gold deposit and a mine entering into production. And that's a really lengthy and tedious operation. And that's why gold mining is a slow and steady operation rather than a boom and bust industry. And so that constraint on supply in the face of high demand is likely to increase the value of gold. Difficult to say with any certainty where I see it going, but I expect gold's price to rise anywhere in between, annually 8 to 10% as an average, as it has done over the last 50 years. Sure, in times of extreme adversity, we've seen gold increase by 35 or 40%. In other years, we've seen it dip, which is when it's a good opportunity to buy. But of course, over the short term, there can be volatility in any asset class. We've heard of some very interesting and enlightening predictions. You know, some people suggest that gold could go up to $5,000 an ounce. You know, some people say that if we revert back to a gold standard whereby gold backs digital currency and we move away from fiat currency to digital currency and gold backs that, well, at that point, you know, the rise of the gold price is unlimited. You know, sky's the limit. I think if we're staying within the realms of reality and the facts as we see them, I would say that as long as there's no limit to the quantity of currency the Bank of England can print, there's simply no upper limit to the gold price in sterling. No.
Great stuff. Well, Josh, thank you very much. It's been a real pleasure speaking to you. And it's nice to hear a bit of bullishness about the gold price, telling everyone, all we gold bugs, what we want to hear. If people want to find out more about your company and maybe use you to buy gold and silver, just let our listeners and our viewers know how they would go about doing that.
Perfect. Well, if you're looking for more information, if you're looking to book in a consultation with one of our consultants who are more than happy to answer all your questions and give you some guidance, go to our website at www.thepuregoldcompany.co.uk. Alternatively, I believe Dominic will leave a link underneath this video, which will take you to a landing page, which will provide you with more information. If you put in your contact details, you'll get sent an investor guide, which will give you some information. And any more information you require, book in a consultation, arrange a time that's convenient for you, and we'd be more than happy to provide you with access to information so that you feel more informed making decisions.
Great stuff. Well, Josh Saul, always a pleasure. Let's speak again in a few months. In the meantime, cheerio.
Thank you very much.